What if you worked 40 years only to get by each month on Social Security? I mean, that's the reality millions face, and John, with average savings, was terrified of ending up the same way. He wasn't chasing crypto hype or meme stocks, but he knew a savings account earning fractions of a percent wouldn't give him the freedom he wanted to travel, to help his family, and retire on his own terms. So he looked for a smarter path. That's when he discovered index funds. And naturally, he wondered, well, what if I put in just $10,000? How far could it really go? In this video, we're counting down the top 6 index funds that John discovered, ranked by the total value they added to his one-time $10,000 investment. I'll show you how each fund grows over time, how much income it could actually eventually generate, and why it earned its place on this list. I'm going to show you an index fund that by the time John retires could be paying him close to $17,000 a month in dividend income. And at the end, I'll show you the one that could leave him with a portfolio worth over $1 million, all from a one-time $10,000 investment. But before we get to number 6, we need to understand why so many people, just like the one John used to follow, fall painfully short. See, John always thought he was doing the right things. Work hard, save a little from each paycheck, put something into his 401k, and over time, boom, it would all add up. That's what most people are told, right? But when John finally sat down and looked at the numbers, they didn't tell the story he was hoping for. As of the making of this video, the average Social Security retirement benefit across all beneficiaries is just $1,955 a month, barely enough to cover basic living costs. Even for retired workers themselves, the average check comes to only $2,008 per month. Spouses of retired workers typically receive $955, while children of retired workers average less than $925. When John looked at these figures, the gap became painfully clear. Rent, healthcare, food, and everyday expenses would easily surpass that monthly payout. And while Social Security provides an important foundation, it wasn't designed to be the sole source of retirement income. For John, the idea of working his entire life just to scrape by on $2,000 a month, needless to say, was unsettling. It was a wake-up. So he started questioning the advice he'd always heard. Buy a house, work until 65, rely on a pension. But pensions are disappearing. Housing's more expensive than ever, and the cost of just living keeps going up. The old plan didn't fit the world he was living in. That's when he discovered index funds. At first, it almost felt too simple. One fund? Really? But the more he learned, the more it made sense. Index funds are like a huge bundle of companies. With one purchase, John could instantly own shares in hundreds, even thousands of these companies. And here's what made John lean in: history. Decade after decade, index funds have quietly outperformed the majority of active investors. Even professional money managers with teams of analysts often fail to beat the simple strategy of just holding the market. Still, he knew not all funds were created equal. Some are broad, some are focused, some pay higher dividends, and some grow faster. So John didn't want to invest money into just any fund. He wanted a system, a way to filter through the options so he could invest with confidence. That's when he came up with a simple checklist. First is diversification. He wanted funds that spread risk across many companies and industries in the selected sector. He knew betting on one stock or even one sector was risky, but if one area of the market lagged, others could balance it out. Second is the expense ratio. Fees sound small, but over decades they eat away at returns. A fund that charges 0.02% keeps far more money compounding than one that charges 0.5%. For John, low cost was non-negotiable. Third, dividends. John liked the idea that his money could earn even more money while he slept. Not all index funds offer dividends, but there are some good options. And to compare those options, fourth on his checklist was dividend growth. He wanted funds where that payout actually increased over time so it could keep up with inflation and help him stay ahead of rising costs. Finally, share price appreciation. John wanted funds with a history of steady growth, not just flat income. He knew appreciation was what would multiply his wealth over decades. So we've got 5 markers here, a checklist that gave John clarity. But now came the fun part, actually seeing how these funds performed. So he lined them up side by side, applied his 5 rules, and tracked just one thing: how much total value each fund added to a simple $10,000 investment over time. So let's kick things off with the fund that came in at number 6 and work our way all the way up to the one that delivered the biggest results of all. At number 6, John has the Fidelity Mid-Cap Index Fund with the ticker symbol FSMDX. This fund is designed to capture the growth potential of mid-sized companies, firms that sit in a sweet spot between small-cap volatility and large-cap stability. These businesses are typically mature enough to avoid the pitfalls of early-stage risk, yet nimble enough to outpace the slower growth of already mature blue-chip giants. For long-term investors, this combination offers both resilience and room for expansion. This fund holds over 800 companies, which means your money isn't tied to just 1 or 2 names. The top 10 stocks make up less than 6% of the whole portfolio, so no single company has too much control over the fund's performance. That's a good thing. It spreads out the risk. If one stock has a bad quarter, it won't sink the whole ship. The sector allocation is well balanced. Industrials make up the largest share at 16.92%, followed by technology at 14.94% and financials at 13.84%. Smaller allocations to healthcare, real estate, and utilities give it a nice balance that can handle market turbulence. Looking back at its historical performance, FSMDX has shown steady strength over time. In the past decade, the fund has gained nearly 124%, including a 60% rise over 5 years and close to 10% in just the last 12 months. On the risk side, this fund has a turnover ratio of 15%. That means about 15% of the fund's value was traded over the past year, buying or selling stocks to stay aligned with the index. It's a bit more active than some index funds, but still pretty low overall. And with an expense ratio of just 0.03%, basically a tiny annual fee, that means more of your returns stay in your pocket. The fund strikes a balance between growth and stability with a current dividend yield of 2.32% and a 10-year dividend growth rate of 4.14%. To top it off, on average, the fund's value has increased by about 8.16% per year. That's the kind of consistent compounding that quietly builds wealth over time. John sat down, ran the numbers, and watched the projections unfold. He wanted to see what a single $10,000 investment in this fund could really become over time. After just 1 year, that $10,000 could grow to around $11,048. In 10 years, it more than doubles to $26,179. By year 20, it hits $64,573. And if left untouched for 30 years, it climbs all the way to $153,077, paying about $993 in annual dividends. Out of the total portfolio value, around $126,771 would come from share price growth, while reinvested dividends add another $16,306, bringing the total value to $143,077. These returns are solid, but there are even better options. In a couple of minutes, I'll show you an index fund that could pay John nearly $17,000 a month in dividends at retirement. And at the end, the one that could leave him with over $1 million from a single $10,000 investment. So FSMDX gave John a solid start. It wasn't the flashiest pick, but the balance of steady growth, solid dividends, and broad diversification made it a reliable piece of the puzzle. Next, John wanted something even broader, something that wouldn't just target one slice of the market, but give him access to everything. That's where the 5th fund comes in, and at number 5, we have the Schwab Total Stock Market Index Fund with the ticker symbol SWTSX. This fund is the definition of full market exposure. Instead of focusing only on the biggest companies, it mirrors the entire U.S. stock market, from the household name giants all the way down to the smaller firms that add depth and balance. That means every time you invest, you're essentially buying a piece of the entire U.S. economy. It holds more than 3,000 companies, while the top 10 names like NVIDIA, Microsoft, Apple, Amazon, and Meta make up about 33% of the portfolio. The other two-thirds are spread across thousands of smaller holdings. While these leaders play an outsized role, the sheer scale of the fund means that stability comes from the thousands of smaller holdings in the background. Speaking of sectors, the breakdown closely mirrors the actual U.S. economy. Technology takes the lead at 33.43%, followed by financials at 13.76% and consumer cyclical at 10.62%. There are also solid allocations in communication services, healthcare, industrials, and smaller slices in energy, real estate, and utilities. On the other hand, history backs up its promise. Over the past year, it has delivered a 17.18% gain, while the 5-year return came in at 90.49%. Stretch the horizon to a decade, and total returns reach nearly 218%. These figures highlight the strength of broad market exposure, steady growth over time, even with the inevitable dips that come with owning everything. On the risk side, it moves almost in perfect sync with the market. Its beta sits at just over 1.00. That means it's neither more nor less volatile than the market overall. With a super low expense ratio of 0.03%, it's incredibly cost efficient, and thanks to its low turnover rate of just 2%, it avoids excess trading costs and keeps things tax-friendly. The fund currently pays a 1.1% dividend yield, and those payouts have been growing at about 6.05% annually over the past decade. Combine that with its average share price appreciation of 12.06%, and it is a strong candidate on John's list. So John ran the projections. He wanted to see how far $10,000 could go if left completely untouched in SWTSX. After 1 year, his investment is projected to be $11,316. After 10 years, it could grow to $33,663. At the 20-year mark, it's projected to reach $109,458. And if he holds it for 30 years, that single investment could climb to around $349,325. Of the total growth, about $330,755 would come from share price appreciation and $8,569 from reinvested dividends, bringing the total value added to $339,325. So SWTSX isn't about chasing jackpots. Its strength lies in simplicity, broad exposure, low cost, and the patience to let compounding do the heavy lifting. But John also wanted something that could serve as the backbone of his portfolio, a fund that captured the strength of America's biggest companies without the need to overthink. And that brings us to number 4. The Fidelity 500 Index Fund with the ticker symbol FXAIX. This fund is one of the purest ways to tap into the U.S. economy. It's designed to mirror the S&P 500, which means it gives exposure to 500 of the largest American companies across tech, healthcare, financials, consumer goods, and more. And with an ultra-low expense ratio of just 0.02%, John saw it as one of the cheapest, most efficient ways to own a piece of corporate America. Looking deeper into the holdings, technology makes up just over 35% of the portfolio, followed by financials, healthcare, industrials, and consumer cyclicals. The top 10 names, led by NVIDIA, Microsoft, and Apple, account for nearly 38% of the fund. At first, that concentration in tech raised a concern for John. Too much weight in one sector could mean sharper swings, but with 500 companies spread across nearly every part of the economy, that risk gets balanced out. The performance track record speaks for itself. Over the past year, FXAIX returned about 17%. Across 5 years, the fund nearly doubled, rising 96%, and over 10 years, it surged an impressive 236%. The ride wasn't perfectly smooth, but the long-term trend showed that patience pays off. Of course, no fund is without risk. The tilt toward technology means FXAIX can be more volatile during corrections, and the weight of the top holdings means results are heavily influenced by just a handful of companies. But with a low turnover ratio of just 3% and rock-bottom costs, John saw very little drag on returns. FXAIX also pays a 1.14% dividend yield, and those dividends have been growing by about 7.01% per year over the last decade. On top of that, it has an average annual share price growth of 12.73%. So, John ran the projections. He wanted to see what a simple $10,000 investment could realistically turn into if he just left it alone. After 1 year, the balance is projected at around $11,387. After 10 years, it climbs to about $35,845. 20 years in, it grows to roughly $124,094, and by year 30, it could be valued at around $421,363. Most of that, about $400,775, would come from price growth, while reinvested dividends would add another $10,588, bringing the total added value to $411,363. Next, at number 3 on John's list, is the Fidelity U.S. Sustainability Index Fund with the ticker symbol FITLX. This fund stands apart from the traditional choices because it isn't only about returns, it's also about responsibility. FITLX invests in companies that meet strict environmental, social, and governance standards. In simple terms, it focuses on businesses that aim to operate responsibly while still growing profits. Looking into the holdings, John realized this wasn't some niche experiment. The fund owns about 281 companies, but over half, about 52%, is concentrated in its top 10 positions. So at first glance, that looked risky. But then he saw the names: NVIDIA, Microsoft, Alphabet, Tesla, Eli Lilly, MasterCard. These are global leaders shaping the future. Nearly 40% of the portfolio leans into technology, while healthcare, financials, and consumer-driven companies round out the rest. That tilt toward innovation helped explain its strong performance edge. The historical track record backed it up. Over the past year, this fund has climbed more than 15%. Over 5 years, it nearly doubled, rising 97%. Of course, no fund is perfect. With 52% of assets tied up in just 10 stocks, concentration risk is always there. If one of those giants stumbled, it could drag performance down. Plus, the turnover ratio sits at 9%, which means the fund trades more often than broader index funds. That can add some extra costs, but the upsides make up for it. The index fund carries a current dividend yield of 1.15%, and those dividends have been growing at an average rate of 13.74% per year for the past decade. Combine that with an annual share price appreciation of 14.34%, and you've got a strong mix. So John ran the projections to see what a single $10,000 investment could turn into. After just 1 year, his balance is projected to rise to about $11,549. In 10 years, it could grow to $42,101. By the 20-year mark, it is projected to be $176,250. And if John lets it compound for 30 years, that $10,000 could be valued at $733,915. Out of that total, about $676,611 would come from share price growth, while reinvested dividends would add another $47,304. Altogether, that's a total value added of $723,915, and by year 30, the fund could be paying around $6,147 a year in dividends, roughly $512 per month. These are good returns, but John also knew there was a big world beyond the U.S. market. If he wanted true diversification, he needed exposure overseas. And more than that, he was curious, could international funds actually deliver even bigger dividends than what he was seeing at home? That question brings us to number 2 on our list, one of the highest dividend payers among index funds. And stick around, because after this, I'll show you one of the fastest growth-oriented funds out there with the potential to turn John's $10,000 into a portfolio worth over $1 million. But first, let's look at John's next dividend-paying index fund, the Vanguard European Stock Index Fund Admiral Shares, with the ticker symbol VEUSX. This fund gives access to Europe's equity markets, tracking a broad benchmark of large and mid-sized companies across developed economies like Germany, France, Switzerland, and the UK. With over $34 billion under management and an expense ratio of just 0.08%, it is a low-cost way to diversify globally without venturing into anything speculative. VEUSX owns more than 1,200 companies, and its top 10 holdings make up only about 16% of the portfolio. That spread means no single company can make or break the fund. Financials hold the largest share at 23%, followed by industrials at 20%, healthcare at 12.6%, consumer defensive at almost 9%, and technology at 7.6%. Some of the biggest names include SAP, ASML, Nestle, and Roche, global players known for stability and resilience. This broad diversification is a smart way to capture European growth without betting too heavily on one sector. Performance-wise, VEUSX is steady rather than explosive. Over the past year, it returned 13.26%. Across 5 years, it climbed 44.76%. Over 10 years, it gained 61.52%. So the growth is slower than U.S. tech-heavy funds, but more measured, reflecting Europe's steadier economic pace. For John, that wasn't a drawback. It was exactly what diversification should look like: different markets moving at different speeds. Risk metrics back that up. With a beta of 0.7 over the last 2 years, the fund is actually less volatile than the U.S. market. Its turnover ratio is just 3%, keeping costs low, and its dividend yield is higher than most U.S.-based index funds. Of course, Europe faces challenges: slower GDP growth, political changes, and currency swings, but the stability of multinational giants makes this fund appealing for the long haul. The index fund also offers one of the highest yields on the list, currently at 2.87%. Even better, those dividends have grown by an average of 13.03% per year over the past decade. Share price appreciation is more modest at 4.56% annually, but paired with dividend growth, the combination is strong. So John ran the projections. What would $10,000 turn into here? After 1 year, his balance is projected at about $10,743. In 10 years, it'll grow to $23,258. By year 20, it could be valued at around $87,170. But the real surprise comes at year 30 thanks to compounding dividends. At that point, his balance would reach $884,436. What's striking is where that growth comes from. Roughly $724,461 of it would be from reinvested dividends, while only about $149,975 would come from price appreciation. Altogether, that's a total value added of $874,436. And by year 30, the dividend stream alone could be massive, around $198,862 per year, or about $16,572 every single month. At that level, John could cover all his living expenses with room to spare. He could pay his mortgage or rent without a second thought, travel regularly, or simply enjoy retirement without the constant stress of budgeting. So, VEUSX gave John something none of his U.S. funds could: global diversification with the solid, dividend-driven returns. But he also wanted to push the other direction, to see just how far pure and one of the best growth index funds could take him. That curiosity brings us to number 1 on the list, the Fidelity Nasdaq Composite Index Fund, ticker symbol FNCMX. This fund is the most aggressive growth option on the list. Unlike broad market funds that spread evenly across all industries, this index fund leans heavily into innovation. The Nasdaq Composite is home to companies that are reshaping how people live, work, and connect, making this fund a natural choice for investors seeking capital appreciation, even if it comes with higher volatility. Looking inside, the scale of this fund is huge. It holds nearly 2,900 stocks, but it isn't spread evenly. The top 10 companies, NVIDIA, Microsoft, Apple, Amazon, and Meta among them, make up nearly 60% of the portfolio. That means the fund's performance is closely tied to these mega-cap names. Sector allocations make the story even clearer. More than half of the portfolio is technology, with communication services and consumer cyclicals accounting for most of the rest. For John, that concentration made it feel riskier than his other picks, but it also explained why the fund's growth has been so explosive. And the numbers speak for themselves. In just the past year, FNCMX surged 26.31%, powered by a rebound in growth stocks. Over 5 years, it more than doubled, climbing 105.87%. Over a decade, the total return was staggering, 356.39%. Those numbers highlight both the opportunities and the risks. When tech leads the market, FNCMX shines brighter than almost anything else. But downturns can sting. On the cost side, the fund charges a 0.29% expense ratio, higher than the rock-bottom funds like FXAIX or SWTSX, but still reasonable given its focus. And with turnover at just 2%, it's clearly built to be held long-term. The real risk here isn't cost, it's the concentration in a handful of massive trend-setting companies. With so much tied to a handful of mega-cap names, FNCMX is especially sensitive to shifts in innovation trends, regulations, and consumer demand. FNCMX is clearly growth-oriented. Its dividend yield sits at just 0.52%, and dividend growth over the past decade has averaged 4.76%. So income isn't its strength. The real story here is price appreciation projected at an annual rate of 17.05%. So, John ran the projections. If he put in $10,000 today, after 1 year, the balance is projected at about $11,757. After 10 years, it could grow to around $49,564. 20 years in, the balance climbs to roughly $240,973. And at the 30-year mark, that same $10,000 could explode to about $1,165,509. Almost all of that growth, about $1,153,098, would come from price appreciation, while reinvested dividends would only add about $2,411. Dividend income itself stays minimal, projected at just $115 per year, or about $10 a month even after 30 years. So, this is not the fund you choose for cash flow, but it is the one you choose when you want pure, aggressive growth. So, both Vanguard and Fidelity offer powerful index funds, but who actually does it better? Click the video on the screen to see them go head-to-head across 5 key categories and find out which one could leave you with over $1.8 million extra in your portfolio.